It is a fact that central banks lease gold. All of the American gold except this tiny little sliver that's it's not even 1% of the gold that's still held by the Treasury. All of it has been rehypothecated. It's been the title has been given to the Federal Reserve, our central bank. The Federal Reserve owes it back, but then they have rehypothecated it, and it's been rehypothecated, and so it keeps on getting lent out on contract after contract. But normally they would go and lease gold from a central bank and deliver the gold that is contracted for and then pay it back later, and they pay a couple percent interest. And so the central bank gets to make 2% interest on that gold. Well, if they are right now trying to unwind all of those gold leases that they've done, that would cause the gold price to rise, and it would be a good reason for this radio silence, basically. The guy that Barron's dubbed the Bond King, Jeffrey Gundlach, who runs an enormous bond fund, now says that he believes holding a 25% gold position isn't excessive. So here's the Bond King recommending 25% gold. What do you think is going to happen? Then, I used this before, but Paulson says gold could hit $5,000 an ounce. This is just mainstream media stuff. How gold could one day hit $6,000 an ounce, according to J.P. Morgan. That was in May. Then, from Simon, he says gold is returning to the mainstream finance. J.P. Morgan accepts gold as collateral. Then, just a few days later, from Correlation Economics, J.P. Morgan knows. And this is their recommendations for your portfolio by asset class: equities, bonds, credit, currencies, commodities. Long gold, silver, and platinum. Platinum, I'll get to that in a minute. Short oil and base metals. Now, if you're going short oil and base metals, you think that there's some bad times coming in the economy. You think that there's going to be less demand for oil, less demand for base metals. Base metals is what you build cars, and houses use copper plumbing and wire and all sorts of things. So this means an economic slowdown or even a depression. This means crisis, long gold and silver, that this is where you want to protect everything. Platinum is a commodity. It's an industrial metal.
J.P. Morgan's strategy, shorting oil and base metals, suggests a looming slowdown. These commodities are the backbone of industries like construction, automotive, and infrastructure. Declining demand here is often a precursor to recessions or even depressions. Historically, when economies falter, investors flee towards safe haven assets, gold and silver. Unlike platinum, which serves mainly industrial purposes, gold and silver have been trusted monetary assets for over 2,500 years. Their enduring role as crisis hedges becomes most evident during periods of systemic stress. The market isn't just hedging, it's preparing for something bigger, and the shift is happening quietly but rapidly.
It's basically a catalyst. In your catalytic converter in your car, there's platinum or palladium when platinum becomes too expensive. But platinum has never been money, it isn't money now, and it will never be money. Gold and silver have been money and the safe haven asset for 2,500 years, and when there's a crisis, which shorting oil and base metals says that they are expecting, people rush toward precious metals, gold and silver. Not platinum, not palladium, not rhodium. They rush to gold and silver. So long gold and silver, I just don't understand why they would recommend platinum. Moving on. I used this in my silver update, but Bald Guy Money, I reported on this 2 weeks ago. The one that I was using is the one that he reported on 2 weeks earlier. The 60-40 portfolio is headed for the guillotine. A 20% allocation would blow all my forecasts out of the water. I was calling for an 8% allocation, which is 20% of the 40%. But what they want here, so this has the potential to be huge. No, way beyond huge. astronomical. I mean, this is like light years stuff. Morgan Stanley CIO favors a 60-20-20 portfolio. So Morgan Stanley is recommending getting rid of 50% of your bonds. This is normally 60-40, 60% stocks, 40% bonds. Get rid of half of your bonds, 50%, instead of 20% of the 40%, and get rid of half of your bonds, 50%.
For decades, the 60-40 portfolio, 60% stocks, 40% bonds, was a cornerstone of institutional investing. But Morgan Stanley's Chief Investment Office recently proposed a 60-20-20 model, cutting bond allocations by half and replacing them with gold. This isn't a fringe view. It reflects growing doubts about bond stability in a high-debt, high-inflation world. The bond market, one of the largest on Earth, is being restructured at its core. If even a fraction of this massive capital flows into gold, the price impact could be astronomical. We're witnessing a quiet structural portfolio shift with profound implications for global asset markets.
And that 50% you allocate to gold, and you end up with a 60-20-20. The bond market is one of the biggest markets on Earth. This is just absolutely astronomical. This is breaking news from Gold Telegraph. Freeport-McMoRan has declared force majeure on contracted supplies from its Grasberg Block Cave mine in Indonesia. Wow. Okay, this mine has one of the largest reserves of gold and copper in the world. Now, so there's less supply coming to market. Normally, a big company like this, Freeport-McMoRan, what they would do in a situation like this is they would go to a central bank and they would lease gold. And I want to thank Brian London, the CEO of the New Orleans Investment Conference, which I'm going to get to in a minute, for this thing. He says probably nothing. Peak administration mentions of the Fort Knox audit, and then radio silence as gold goes through the roof. Well, they are it is a fact that central banks lease gold. All of the American gold, except this tiny little sliver that's not even 1% of the gold that's still held by the Treasury. All of it has been rehypothecated. It's been the title has been given to the Federal Reserve, our central bank. The Federal Reserve owes it back. But then they have rehypothecated it, and it's been rehypothecated and rehypothecated, and so it keeps on getting lent out on contract after contract. But normally, they would go and lease gold from a central bank and deliver the gold that is contracted for and then pay it back later, and they pay a couple percent interest. And so the central bank gets to make 2% interest on that gold. Well, if they are right now trying to unwind all of those gold leases that they've done, that would cause the gold price to rise, and it would be a good reason for this radio silence, basically.
Adding to this financial pivot is a tightening physical gold supply. Freeport-McMoRan, operator of one of the world's largest gold-copper mines in Indonesia, declared force majeure, disrupting contracted deliveries. Traditionally, companies bridge such gaps by leasing gold from central banks. But current silence from institutions like Fort Knox and the LBMA suggests something unusual: potential unwinding of massive gold leases, reducing available supply. Simultaneously, the Intercontinental Exchange restricted public access to gold and silver price fixes, raising transparency concerns. When price data disappears, it often signals systemic stress, akin to shredding evidence before the storm hits.
The LBMA hides gold and silver fix, stops providing current and historical prices to Kitco. Literally nothing to see here, folks. Move along. This is from Nick Laird at Gold Charts R Us. I've been instructed by the ICE that I am not allowed to display the LBMA gold and silver fixes upon my website as I don't have a license. Here is the ICE. It's the Intercontinental Exchange. That's where the LBMA prices come from. Why would they hide these? Well, if you are being caught committing a crime, if you're being charged with a crime, the very first thing you do is you gather up all the files and you head to the paper shredder and you shred them all and get rid of the evidence. Well, that's what they're trying to do, is get rid of the evidence so that people like Nick Laird can't do this great investigative reporting. This is just math. The red line is the price of gold. The black line is the price of gold if only the London hours were traded. In other words, from the AM fix throughout that trading day to the PM fix, if that was the only trading that goes on, and then you paste that to the previous night's close of the London trading only, what you end up with is gold went from 1971, it was at $35, and today it would be $2.24. If you only take the trading at the close of London when the rest of the world is trading, and you take those hours, the percentage change in price during those hours, and you paste it to the previous day's close of the percentage change of non-London trading hours. Everybody else in the rest of the world, you come up with $50,000 gold. Now, this is just little by little, day by day, bit by bit, but this criminal price suppression actually is the great opportunity that has been provided to the precious metals investor. They are losing control, and as they do, the price will explode. This is the metaphor of pushing down on a spring, and when you lose control, it's going to bounce a lot higher. And so this criminality from them is your great opportunity. Luke Groman, I want to thank Luke for this wonderful chart. The red line.
Gold's price has long been artificially restrained, particularly during London trading hours where major price fixes occur. Analysts have shown that if global trading had been priced outside London's influence since 1971, gold could theoretically exceed $50,000 per ounce today. This persistent suppression is like pressing down on a spring, temporary but unsustainable. As control slips, the potential energy built up over decades could unleash a rapid price surge. Recent charts reveal correlations between gold and real interest rates breaking down post-2022, coinciding with geopolitical shifts like the U.S. seizure of Russian reserves, events that reshaped global trust.
The red line is the S&P 500. The blue line is the S&P 500 priced in gold, and the S&P 500 has lost 21% since August 15th, 1971. It's down 21% priced in gold. And, gold was $35 an ounce then. Sovneteg, I'm not sure how to, but 1 year ago today, this was September 19th, the Federal Trade Commission posted this warning saying anyone who tells you to withdraw money, that's currency, not money, and buy gold bars, which is money, to protect is a scammer. And here it is from the FTC, Federal Trade Commission. Did someone tell you to buy gold bars to protect your money? No, it's to convert your currency into money, and that protects your purchasing power. It's a scam. Well, let's see how well the FTC has protected everybody. Oh, let me see. Gold is more than $1,000 higher. We're in the 26s. It's $1,100 that they protected you from making on profit, which is a 45% return over that same time period. So, Geiger Capital. Gold stopped tracking U.S. real rates in 2022. And this is the 10-year Treasury inflation-protected security, the TIPS, so inflation-protected U.S. Treasuries. And it's a little bit different than the 10-year minus inflation, the real rates. But look at the correlation here between the price of gold and the 10-year inflation-protected Treasury. The correlation up to here is probably something like 0.97, 0.98. So 97, 98% the same. And then this divergence in 2022. Why?
Since 2022, Western investors have been selling gold ETFs while central banks in emerging markets accumulate at record pace, accelerating de-dollarization. At the same time, the U.S. dollar has lost 50% of its value relative to gold in 3 years, a stunning reality many overlook. Regulatory bodies once labeled gold buying as risky, yet investors who ignored them saw gains exceeding 40%. Diverging gold correlations, geopolitical shifts, and shrinking supply all converge into a single narrative. The world is repositioning around real assets. For those paying attention, this isn't merely a trend, it's a generational financial reset.
In 2022, the U.S. decided not just to sanction Russia for the invasion of the Ukraine, but to seize Russian assets and reserves. And that put all the world's central banks on notice that America has become this lawless country, just basically violating the rules of the international monetary system and going ahead and seizing another country's assets just because we don't like what they do. This is the 10-year real rates versus gold, so it's the 10-year minus, and it's a little bit different. You didn't see this big dip in the other chart, but still the correlation is mind-bogglingly huge. And then this sudden divergence at the beginning of 2022. And what is very interesting is the spot gold versus total gold ETF holdings. It's not the beginning of 2022, but the end of 2022, beginning of 23, it diverges. And the correlation here is just absolutely spot on. And that means that it was the West driving the gold price back then. But something changed, and it is no longer the West. We've been dishoarding gold. We've been selling, while the rest of the world, somewhere else, central banks, including the rehypothecation, the dehypothecation, the unwinding of all of those gold leases might be part of this. I have no evidence, not saying that it is. I'm saying it's a theory. It might be part of the rise in the gold price, because as you unwind these things, there are fewer and fewer ounces of imaginary gold out there. And as you have fewer and fewer ounces in the same gold market with the same amount of cash in it, the price has to go up. And so I just find it interesting that these charts are all diverging at about the same time. And Spencer says, the dollar has lost 50% of its value versus gold in the past 3 years. 50%. Understand where we are. You now live in a third world country. And boy, is he right.